Hi guys, I hope that you guys are doing okay and that you are busy preparing as we are just about to write our paper 2. In today's class, we're going to be looking at budgets and we're going to focus first on the Eastern Cape paper for the year 2023, and we're going to look at question number 4 of the Eastern Cape Prelim paper. So in this paper, they brought us a projected income statement. I want to encourage you to prepare for both the projected income statement as well as the cash budget. So we should prepare for both the projected income statement and the cash budget. If you look at what we have here, the first question, which is 4.1, lists two items of income or expense that will not appear on a cash budget. So those ones are easy for you to do that. I'm not going to do that for you. You should just go and study on those ones. I think you find them in many of the workbooks that you have been provided throughout the year. And then in 4.2, it says calculate the missing amounts denoted 1 up to 4. So these questions come in different shapes and different approaches. So the best you can do is to prepare all the calculations that can come. And we're going to do these ones. After these ones, we're going to look again at maybe two other papers and see how these questions were asked. So in 4.2, we're going to start looking at question number 1, which is denoted in the projected income statement. So to begin with, our number 1, we are calculating cost of sales. And if we come here, you will see information A, which says the business uses a markup percentage of 60%. So this one would be an easy calculation because you are calculating cost of sales. So if you're calculating cost of sales, you are simply trying to get the 100. So what you want is your 100 and what you have is your 160. That is your cost of 100 plus the markup 60. So it's 100 over 160. Multiply this by your sales that is given, which is your 246,400. So if you multiply this on a calculator, you should get 154,000. All right, remember to bring the answer within this answer column here. All right, there were other ways in which one could have done this. I'm just going to show you one single way and then I will move on to the next one. The next one, which is number 2, says calculate the rent income. Calculate rent income, which is number 2 over there. All right, so we come to the information on the rent income, and it says information E, rent income will increase by 7.5% per annum commencing on the 1st of July. So rent income will increase by 7.5 commencing on the 1st of July. That simply means here in the month of June, rent had not increased, but in the month of July, rent has increased. So I would say the month in July is now 107.5%, and what you have in June is your 100% before it has increased. In that case, what you want is your 100% before it is increased over 107.5%, that is after increase, and that is 16,340. If you punch that in your calculator, you should get the 100%, which is your 15,200. That becomes your rent income. So the examiners normally love this adjustment whereby you are given the amount after increase and you have to calculate the amount before the increase. Okay, then number three, it says salaries for the 2 managers. That is number 3 over there, salaries for the 2 managers. And then adjustment number C is the business employs a sales manager and an office manager. The office manager earns 300 more than the sales manager per month. The sales manager will receive a 5% increase effective from the 1st of July. All right, so what we want to do is to get the manager's salaries. Remember, there's a 5% increase effective from the 1st of July. All right. So let's take into consideration that there are two people, managers who are employed. The office manager earns 300 more than the sales manager per month. So we would come to what they're earning, which is your 18,700. 18,700. Then we will take out the difference between the two, which is your 300. So you say 18.7 minus the 300, and then it will now give you your amount, which is your 18,400. So the 18,400 is what these guys earn for the two of them, without the other one earning more than the other, because the office manager earns 300 more. So if you take what the office manager is earning more, then you get 18.4. You divide this by 2 now, then you get now the fact that each manager is earning 9,200. Okay, so each manager is earning 9,200. Then you now say the office manager who is earning more than the other. So you took that one out, remember, you got 18.4, you divide that by 2, then you get the 9,200. Then the sales manager will receive a 5% increase. Then we now say for the sales manager, you will now say the 9,200. Then you increase it by 5%. That is, you're going to get 105 over 100. That means this manager will now get 9,660. That is the sales manager. But remember, the office manager was getting 9,200, and he was getting more. Remember, the office manager was getting more by 300. So the office manager, this is the office manager, he was getting 9.5. So it would be 9,660 plus the 9.5 for the office manager. Okay, so the office manager, remember, was getting 300 more, which is 9.5. So you end up now with the sales manager getting 9,660 and the office manager getting 9,500. And if you add these two, you now end up with 19,160. This becomes your manager's salaries. All right, then I'm going to quickly move on to the next one, which is number 4. That is your operating profit. For your operating profit, it was rather easy because you were doing the bottom up calculation where you had your 59,000 and you're going up. So you would then subtract the 640 because here it is interest income. Interest income is added. So we want to know what you had here that you added this one to get to that one. So if you do the opposite, then you get that amount. So you would say 59,940, then you say minus 640. That will give you 59,300. That becomes your operating profit. Okay, I'm going to quickly come to 4.3, and it says calculate the cost of the new vehicle purchased. All right, let's see if we have information. A delivery vehicle was purchased on the 1st of June. Vehicles are depreciated at 15% per annum on cost. All right, so we can see that there is a vehicle that has been purchased because our depreciation has increased from 12,000 to 14,875. There were several ways in which one could have done this, but I'm just going to show you the quickest way. The fact that our depreciation has increased from 12,000 to 14,000 means there is an addition to our vehicles, and the opposite is true. If we had 14,000 here and then now here is 12,000, that means we have disposed an asset, hence our depreciation would have gone down. Please take that into consideration. Here we can see an increase, a new vehicle. If it was a decrease, it would have meant that we have also disposed a vehicle. So the examiner can use either of these ones. So It simply means the depreciation of the new vehicle would be the difference between the new depreciation and the old depreciation. So the new depreciation is 14,875. Then we subtract the old depreciation, which is 12,000. This would then give us 2,875. This is the depreciation for the new asset. So we then take the depreciation for the new asset, which is 2,875, and we would say for the entire year, how much would it be? So you multiply this by 12. All right, so you take that depreciation, you multiply by 12, and then you then divide it by the depreciation rate, and the depreciation rate is 15%, which is 0.15. All right, and then that will give you your cost of the new vehicle, which is 230,000. Here I just tried to summarize out the calculation. So I just took the depreciation, multiplied by 12, divided by the depreciation rate. That is what I simply did here. All right, because we want to know what was the cost of the new vehicle, and the cost of the new vehicle is 230,000. I've seen this adjustment. They can come and use it with a loan to see if we have received a new loan or if we have paid a loan. It can also be tested on the fixed deposit. Did we receive a fixed deposit, or we have repaid did the fixed deposit mature rather, or we have invested in the fixed deposit? So I want you to look at this adjustment either on the vehicles, on the loan, or on the fixed deposit. The examiner can test this one on either of these ones. And then the last one, I think this one was an easy one, where you calculate the savings on the interest on loan after the loan repayment. They're simply trying to say we were paying interest on the loan of 6,300 here. We're paying interest on the loan of 6,300, but interest on the loan has decreased. You see that? That simply means we have paid back the loan. That's why interest has decreased. Now that interest has decreased, by how much has it decreased by? Because it has decreased to 5,250. How much has it decreased by? That's what the examiner was asking. That is 1,050. That was the answer. The savings on interest on loan. How much are we not paying anymore on the loan because we have repaid the loan? We're paying 6,300 on the loan before we repaid the loan. Now that we have repaid the loan, how much are we paying? We're now paying 5,250. How much are we not paying? We are not paying 1,050. Remember, we had intended to pay 90,000 on the loan. That is what we had intended to pay. All right, so if you would want another method, you can still get that amount from the 90,000. That is another way that you could have done that. That is to say, your 90,000, if you have your calculator close, your 90,000, you multiply that by your 14%. Remember, the interest rate is 14%. 90,000 multiplied by 14 over 100, and then remember, you want for 1 month 1 over 12, and then it should give you your 1,050. Okay, so the other question that you have to prepare for, guys, is your control questions, your controls. Definitely, you're going to be asked on controls. That is your expenses, your income, how the business is controlling expenses. You need to be able to comment whether the business has overspent or underspent, and by how much. It is good that you also quote figures. Very important that you quote figures and percentages. So I'm not going to do any control in this question. We'll see if we can do controls in the next question. But I want you to prepare on your controls. Controls on your income, controls on your expenses, whether the business has collected enough as it was supposed to have collected. Those are questions that we need to prepare on as well. All right, guys, I'm going to end this video now. All right, see you when we do the next one.